Hello and welcome to yet another video in Kotak Stock Shala. And this video we are going to go deeper, as we discussed in the last video, into asset allocation. So in the last video we learnt about 4 different kinds of asset classes. We learnt about fixed income, we learnt about equities, we learnt about gold, we learnt about real estate. Now let's try to understand what is the kind of returns you should expect and the kind of risk you are taking in each of the 4 asset class. Again, these are all indicative data points. You need to consult your financial advisor. But if you see the slide, the fixed income has the least expected risk, and at the same time, the potential return which you can generate is also on the lower side. As we grow higher on the curve, you can see gold, which is relatively lower risk and gives slightly higher returns as well. So these are generally more of a defensive assets. And then as you go higher on the risk curve, you will see real estate, which is slightly more risky. And then you have equities, which is even more riskier, but at the same time, you can expect higher returns also into it. And then there are a lot of speculative asset classes like crypto. Now, given the tax uncertainty and the issues around crypto, I'll not go deeper around it. That's again your personal individual choice, but we will focus only on these 4 major asset classes. So let's move forward and try to understand what is the nature of returns and how these asset classes generally behave. So if you see debt, it fluctuates between the range of 5.5 to 8% in India because the inflation has been almost in the similar range and it has been range bound. So slightly higher returns than inflation is what you generally get in India. So if you see last 20 years data, it is almost in the same range. If you think about the compounding, for almost 25 years, if you have been putting money into debt and if it compounds without even hitting the taxation, it generally multiplies by 6 times, considering average 7 to 7.5% returns. So as I told you earlier, debt or fixed income instrument could be a great security bucket of your asset allocation, but they don't grow your money substantially over a period of time. But at the same time, if you think about the compounding, this is the historical data, doesn't necessarily mean future also will be like this. But if you want to just get an idea of difference between compounding of debt instrument and equity instrument, this is the Nifty 50 chart of last 33 plus years. And if you see around 30 years, it has multiplied by around 75 times. That is the kind of compounding. Even if you compound at 13%, you can achieve 13 to 14% kind of compounding. Now, there is a very powerful video by Mr. Ramesh Damane. You can check it out on YouTube, which talks about 25% plus compounding, where he talks about how a 10 lakh rupees investment can become 100 crores in 30 years if you compound at around 25%. And as a retail investor, that should be your goal, that how you can actually focus on compounding at a higher rate and how you can compound for long term into equities. But there is a caveat here. Yes, equity investing comes with a lot of volatility. So we had Harshad Mehta scam where market fell by 47%. We had subprime crisis in 2008-9 where market fell by 60%. We had recent COVID where market fell by around 38%. So equities needs a lot of patience. It needs a different mindset. It needs right advice, and also it requires right temperament to hold on during these drawdowns. And also you need to understand that this could be an opportunity sometimes if you think about it, because if there is a market crash, you can actually buy these assets for much lesser value also. So think about it, understand the volatility and make best use of it. Now, equities is generally for long term. If you focus on equities and stock investing for a very short period of time, the probability of you losing money is on the higher side. But as you move forward, after 3 to 4 years, the probability of you losing money goes down drastically. If you see the historical data, in fact, it has gone down almost to zero. And that is one more principle which I learned from this book called Rich Dad Poor Dad, that the difference between rich dad and poor dad is that poor dad doesn't take any risk at all. They want to go on the safest side of the things, but rich dad wants to take calculated risk. They want to see that, hey, if I lose this, I don't lose much at a aggregate level, but if I win, I can make it big. And that is how equities should be seen, that over a short period of time, it might contain a lot of volatility and you might feel there is a lot of drawdown, but it is a very powerful tool for long-term wealth creation. Because if the economy grows, and country like India, which has been growing at a very good GDP rate, if it continues to grow, the businesses in the country will grow, and hence there is a high probability that your investments into these businesses, these stocks, will also tend to grow over a period of time. So that is why it is very important to invest in equities. Coming to gold, as I said, there are extended period of volatilities and there are big cycles. So it can happen that gold compounds for a very long period of time. Again, for many years, it will not do anything. And then again, the rally will start. And similarly, there is real estate where there are long gestation period. For few years, it keeps growing. And for a few years, there might be dull cycle. But over a long time, even real estate has done a good job in terms of compounding. So around 10% compounding in real estate in last 23 years, it has multiplied your money by around 9 times. So these are 4 asset classes. We have gone deeper in terms of understanding the risk, understanding the volatility, understanding how these asset classes generally behave. And the next thing which we are going to do is understanding how much proportion of these asset classes you should ideally have in your portfolio and how to get sense of it. So what we'll be doing is we will use ChatGPT. Again, this is an indicative exercise where you just understand what is risk profiling and how it is done. But as I said earlier also, you need to consult your financial advisor to get it right. Okay, ChatGPT is not a substitute of your financial consultant. So please make sure you consult your advisor. So what I'll do is I'll just create a new ChatGPT and I'll put a prompt that, hey, ask me risk profiling questions for my asset allocation decision. I'm an Indian citizen. I want to ultimately decide between fixed income, equities, gold and real estate, and ask me question one by one. So what ChatGPT will actually do is it will throw you all the important questions which are relevant for risk profiling. Like first, it has asked me, how long do you plan your major investment? What is the horizon which you are looking for? Let's say for me, it would be 5 to 10 years. And similarly for you, it could be a different time period. And then it is giving me second, question that if your portfolio falls by 20%, what will be your reaction to these kind of market volatility? And so on and so forth. So when you put this prompt, you will get idea around what are the questions that are relevant for risk profiling. And that same exercise you can actually do with financial advisors. And if there is any deviation, you can check with them why you think there is a deviation and whether it is important for you to consider or not. Right? So this is the exercise which you need to do and create your risk profile. And after that, you need to bifurcate your asset class based on how much you should put your net worth into fixed income, how much should be in equities, within equities, how much should be into small cap, mid cap, large cap, and any international stocks also if you want to consider that, and how much should be in gold and real estate. If you do this exercise, it will give you clarity to invest properly, and also it will help you to review it periodically. Ideally, every 3 to 6 months, you should review your asset allocation so that you are on the right track. Hope you enjoyed this video, and I'll see you in the next video where we are going to just connect the dots, understand how the entire risk profiling looks like, what are few more prompts which you can exercise into your journey, and how you can actually use this knowledge practically in your investing journey. Thank you so much for watching. I'll see you in the next video.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.